Welcome. My name's John Broome. I'm the chair of the Contracts and Procurement SIG, and I'm also participating for 10-15 minutes as a presenter for this webinar. First thing I'm going to do is just give a quick series introduction. This is the first of 3 webinars. Part 1 is this one. It's about selecting the right, a financially sound provider. Part 2 will be 10 ways to protect yourself through the contract. That's on 3rd April. It's already listed on the APM website as an event, and Sarah Shute will be delivering that. And she got very good feedback on her series of 3 webinars on what every project manager should know about contracts. The part 3, which is provisionally for 30th May, will be by Alistair. Alistair's a very experienced international project manager, and he will be giving some real-life examples on a £800 million international project where he had 2 people who Dun and Bradstreet said were fine, basically not being fine, and it will be what's the early signs out in reality of that happening, what do you do as they are going there, and what you do once they have become insolvent. Okay. So in terms of the key questions for today, as all of you will know, Carillion became insolvent, and it seemingly took many by surprise. But was it really a surprise? How would you know if it wasn't a surprise? What should you have been looking for? And importantly, what can we learn from it so that in your daily, weekly, monthly, or whatever experience as a project manager, you don't appoint a provider who's going to become insolvent during the course of your project. As an overview, I will hand over to Philip in a few moments, and Philip will introduce himself and give a few comments on his background, but you can see what he's going to cover. I'm then going to do a quick overview of Carillion's accounts leading up to them becoming insolvent, and then I'm going to hand back to Philip, who will finish off and say, well, effectively, what are the lessons learned and what can you do about it? A quick disclaimer: really, neither of us are financial experts, accountants, etc. So we're just raising your awareness. The purpose of this webinar for you as the audience really is to raise awareness of the more obvious signs so that you can refer to the experts and have a meaningful conversation with them. But it is not to advise you on any specific procurements, make you into financial experts or anything like that. So over to Philip now.
Good. Thank you, John. Just to briefly introduce myself, I'm Philip Reese. My details are there on the screen. I've been working in commercial and procurement roles for over 20 years, during which time I've been involved in the procurement of projects, services and works ranging from smaller local contracts all the way up to large frameworks worth hundreds of millions and sometimes billions of pounds, both in the UK and internationally. Much of this work has involved the need for selecting financially sound supply chains and selecting approaches to undertake as much due diligence as necessary, either by myself or, when necessary, calling on specialist advice when things might become less clear. I've been quite fortunate in early years of my career to have received formal education as part of doing a degree in commercial management. I appreciate that many of you listening today may well not have a commercial or financial background, so we're going to do our best to try and keep the terminology light and as easy to understand as possible. What we're going to look at first of all is what does it mean to be insolvent or bankrupt, and what effect may it have on the project manager on a day-to-day basis as you're delivering your project. We will be making the slides available, as John mentioned, so please don't feel like you need to be taking copious notes as we go through. There is a lot of information here which you can retrieve later as an aide-memoire should you be interested in using it. So the first matter to clarify really is one of terminology around insolvency. When we're dealing with companies, the appropriate term to use is corporate insolvency. So, for example, Carillion became insolvent. They did not become bankrupt. If they were an individual person, then they would be bankrupt, but as it's a company, the term is insolvency. There's a lot of information around the different types of corporate insolvency available on the government's Insolvency Service website, which is on the screen there. So we won't spend too much time going through all the different types in detail today, just for you to be aware that there is a lot of information there. What is relevant is to know that for each of the different types of insolvency, there are formal procedures which apply to each different type. So what does it mean to be insolvent? So insolvency is a state of being unable to pay the money owed by the company on time. This can be either, firstly, not enough liquid assets or cash flow insolvency, or the second type of insolvency could be where the company does not have enough assets to pay off all of their debts. For example, comparing the balance sheet, looking at the difference between the assets of the company and its liabilities. Both types might clearly have an impact on your project. After all, as they say, money makes the world go round. So if a company does not have the cash available to continue trading, clearly there will be an issue. The term technical insolvency is most often used to describe the second type, or balance sheet insolvency, which means that the company's liabilities are greater than its assets available. This is an important point to understand. Companies might well go on trading for some time when technically insolvent. Some may well go on indefinitely, especially if they're later able to recover their financial position due to an upturn in their circumstances. There is plenty of information available to help you and to identify and predict these companies who may be deemed to be technically insolvent long before you may decide to enter into a contract with them. Just to stress though, it doesn't necessarily mean to say that you should avoid companies who are technically insolvent. You just need to go into these types of arrangements with your eyes wide open and understand some of the potential risks at hand. Every organisation will have its own appetite for the level of commercial risk it takes, and it's up to the organisation to decide in the individual circumstances what it does with the information available. So the types of insolvency. If a company is technically insolvent, then there are a number of ways this can manifest. Like we said, some companies might well go on trading and stay in a state of temporary or permanent technical insolvency for some time before anything formal actually occurs. If the organisations that the company owes money to become concerned about whether or not they will receive their payments, then they may start to want more formal arrangements to try and recover, and I emphasise try to recover what is due to them. The first option, and generally best for all parties concerned, is to come to a creditor agreement, whereby the company who is technically insolvent agrees with those companies who it owes money to how much it will pay and when, effectively a payment plan. If this does not work, and in the longer term the company needs to enter a formal state of insolvency, there are 4 different types of formal insolvency. These are a company voluntary arrangement, a CVA, administration, receivership, or liquidation, which is often referred to as a winding up or closure. The type of insolvency will depend on the circumstances of each company. Again, we won't go into the detail of these today. There is plenty of information about these on the Government Insolvency website. What we will do, though, is we'll take a little time to look at Carillion, who fell into the 4th type of insolvency, which is liquidation. Liquidation effectively ends the company. It winds up the affairs of the company. Now, either the company can do this themselves. So, for example, a company may not be technically insolvent, but the directors may well just decide that they've had enough, they're closing up the company for whatever reason. So there can be a voluntary liquidation, or where creditors, i.e. those who are owed money by a company, decide that they've had enough and they want what is due to them, they can apply to the courts for a winding up order, and that is the route they would then take to try and recover what is due to them. simple terms in the liquidation, the assets that are available can then be cashed or liquidated, and then they are distributed in order to the creditors, i.e. those who have funded the liquidated company. If there are sufficient funds, then the cash is distributed to the creditors. In any type of insolvency, the order of payments to creditors is broadly the same. Unfortunately, by definition, i.e. if the company is technically insolvent, there is unlikely to be sufficient funds for everybody in the list to get what they are owed. So any form of formal insolvency is generally where the company does not have sufficient funds, a bad deal for all concerned. Certainly those towards the lower end of the queue. The supply chain and customers, for example, you may be a customer of a company who has become insolvent or liquidated, and not necessarily just a supply chain member of theirs. So it could be your client, for example, or you may be the client yourselves. They tend to be down towards the bottom of the list. They come under what is underlined there as unsecured creditors. So by the time these organisations get any chance to make a claim to money, it's quite possible that there won't be very much, if anything, left. And then right down at the bottom there, you've got the shareholders who will get even less of what's left. So as you can imagine, these unsecured creditors, the supply chain, etc., they're going to be very important, and that issue is going to have a significant impact on any project. So let's move on now to talk about the impacts. So any liquidation or insolvency will have an impact, and if it concerns one of your suppliers or your clients, there will be impacts on your project. In the case of Carillion, there were many impacts as are listed on the screen here, and they've been widely reported in the media over the past year. Whether these apply to project delivery, political ramifications, redundancies, etc., as well as many other knock-on effects on other projects and other companies involved in the industry. In the case of the Carillion liquidation, some of the projects they were working on are still only now getting back to work. There is a byproduct, however, as you may well be aware, is that we are now starting to discuss a number of the issues surrounding the collapse. So perhaps there may be something helpful which comes out of this. For example, hopefully this webinar will start to focus some opportunities. There are other initiatives ongoing. For example, there are reviews of industry payment practices ongoing, and various bills seeking their way through Parliament, for example. To summarise some of the impacts you may see on a day-to-day basis, for you as project managers, there are generally four headings we could class these impacts under. Project delivery to individual workers or managers on the project, to the customers, clients, or other organisations. And lastly, and often critically, the wider perception, either to the industry at large, or even questions over aspects of the economy in general. Any one of these categories can clearly have an impact on both you and your project. Just to look at a couple of these. On delivery, can you actually deliver the project? How disruptive would it be to you? As you will well know, projects are often extremely busy places to work at the best of times, without added complications. On a personal or an individual level, how will it affect people's general well-being? How will it affect workers' morale? At an organisational level, will the project even be able to proceed? Will there be sudden competition for resources over time, over labour, over materials? And of course, as you know, the general perception, there's been much made of the collapse of Carillion in the media, which is quite often extremely time-consuming and distracting. What we're now going to move on to look at, now that we've touched on some of the impacts and the essence of what insolvency is we're going to look at some of the sources of financial information that are available for the purpose of due diligence. Firstly, we'll look at one of the main sources of publicly available information, the company report, and then we'll look at a number of other sources available too. And John is going to take a look in a bit more detail around how some of these sources applied to Carillion. Company reports then. Contrary to popular belief, anyone can get hold of these. It takes a matter of seconds via the Company's House beta service, and the website is there on the screen. Company reports contain a history of the financial affairs of a company, and some of the key ingredients to a company report are highlighted on the screen. For example, details of the company directors, the accounts, history of the filing, any charges brought, and any previous insolvency proceedings. Also, if there is a company that you may use a lot in your sector or in your organization, you can also seek to follow them online so you get alerted when anything changes. So plenty of opportunity to keep abreast of that information. So what can company reports or corporate reports tell us? Generally speaking, they give you a general picture of the financial standing of the company, from which you might start to infer insights. For example, whether they are solvent, insolvent, so it can be useful in many situations. It's not just about avoiding insolvency. It can also give you plenty of other information about the company in question before you start to look to trade with them, or even give you plenty of information around a sector on the whole. For example, you can start to glean information such as, do they pay their own suppliers on time? Might their cash flow impact on their ability to do a good job for you? Have they got the financial resource to complete the project on time? Will you need them to be able to borrow money to deliver your project? If so, are they able to borrow any money? And what is the long-term outlook for them? For example, if you're relying on them to provide you with warranties or guarantees, covenants or bonds, parent company guarantees, will they be able to do this? And alternatively, if the company you're looking at is your client, are they going to be able to pay you in a couple of months' time once you start work for them? So corporate reports, firstly, they're a statutory requirement, so all companies have to produce them. They're a report to shareholders and funders on the state of the business and the performance of the management of the business. Now, they are backward-looking, so what you see is numbers for the previous years and not necessarily the current and future state of the business. The report identifies, measures, and communicates recent business information to enable you to make judgments and to make decisions, and not just yourselves as doing due diligence, but also a wide range of stakeholders, both inside and outside of the company in question. There are a number of caveats, however. Company reports are not precisely accurate. Accounting data, by its very nature, relies on assumptions, accounting judgments, and accounting policies. The information should ideally be based on consistent approaches from year to year, so you can compare trends. However, sometimes, and John will go into this a little bit later as well around Carillion, sometimes accounts may not be consistent in their set out from year to year, and that can cause some complications where you might need to get further assistance with dissecting and understanding what they're telling you. There are a number of things in a corporate report. Today we're really going to focus on the top three items there that are highlighted: the profit loss account, the balance sheet, and the cash flow statements. Before John gets into looking at the Carillion reports a little later, there are a couple of basic things we might want to consider when we look at reports. Firstly, is the business actually a going concern? i.e., is it going to continue trading, or have the accounts been drawn up on the basis that it will cease to trade? Is the report easily understandable? If it's not easily understandable to the layperson, why not? What is overcomplicating this business? Are the accounts prudent, or are they overconfident? For example, are they counting on profits before they're actually realized? And is there a consistency from year to year in the approach? Importantly, when John looks at some of the financial reports later on with Carillion, he will introduce what are known as accounting ratios. These are key pieces of information which can be very easy to identify in the report, and they will give you a very quick overview of some of the key aspects of the financial health of the company. When looking at any company report, and in particular trends and ratios, may be wise to remember a proverb widely used by the investment community. That being, revenue is vanity, profit is sanity, but cash is king. In context, a company that you're looking at may well be very big. They may on the surface be winning lots and lots of work. But are they financially sound? And importantly, are they actually solvent? As well as company reports, there are other sources of information should you find that you need more information, and especially right up to the minute information. You have to request these, and you often have to pay for these, so it's generally best to use these sparingly and only where you really need to. These might include management accounts, other management information, and credit agency reports. We'll look at credit reports first. There are many providers who you may well have heard of, such as Dun & Bradstreet, Bureau Veritas, etc. Many business banks also offer credit rating services as part of your business banking arrangements. Credit reports take away the need for you to interpret the accounts yourself to an extent. They can also be much more up to date than a company report, which in some instances can reflect information from up to 2 years ago. Requesting a credit report can take just a couple of minutes, so you can get very useful and current information very quickly. Some of the key information you can get includes warnings about a company. So as an example, on running a credit report about Carillion back in 2016, the first word that came up on a particular report was caution, which I would imagine should have raised some alarm bells. There were various other considerations in the reports for the organisation to then think about, either before tendering, either before even contacting a company, or even thinking about contracting with a company. For example, reports can sometimes suggest a maximum contract value, which you should consider as a guidance for how much work you would give a company, say, within a year. So company X don't award any more than £10 million this year, for example. There are various other types of information that can be gleaned from credit reports, and it very much depends on what you pay for with your credit agency. Again, that's very much a decision for each organisation to make your own decisions as to how far you want to go with your due diligence. Next of all, we'll have a quick discussion around management accounts. Management accounts are not public information, but they are, in a sense, an excellent and useful source of more detailed information. Discretion is required when looking at management accounts. They are private documents, so if you are going to discuss management accounts with a company, then you will want to make sure that you're discussing it with the right people within the organisation and not airing out close to dry in public. There's no set format with them, so you can tailor them to what you want to see, and they can give you immediate information. For example, weekly or monthly plans of what is happening right now. They're very useful for you looking into the future as opposed to looking into the past. There are some drawbacks with management reports. They're not audited, for example, so you do need to make sure that you understand what you're looking at and you're confident in the information provided. But do remember they can be quite expensive to produce, so only really think about using them when needed. I'll hand over to John, who will take a look at some of the similar financial information from Carillion.
Okay, so firstly, a little bit about me. On and off, I've been chair of the Contracts and Procurement SIG for the last 10 years. My area of expertise is not in selecting the provider. So what's my qualification for talking about this? Well, essentially, 7-8 years, I got fed up with paying for low returns. So I decided to start investing myself, initially in funds and then looking at individual companies. I would say that my investment style is growth at a reasonable price, but underlying that is financially sound companies. So if the growth doesn't project out, they're not going to become insolvent. My filtering process is financial publications, which, that company sounds interesting. Then look at the profit and loss account and they're growing, and then I'll look at whether they're financially sound. Since we started planning this, I've actually been appointed as a board director for the APM, and I'm its investment champion, which means that I oversee the portfolio of investments. Don't invest it, I liaise with the people who do invest on our behalf. So what will we look at? Well, we're going to look at Carillion's income statement, balance sheet, cash flow statement, and then some of the financial indicators and other sources over time, which is fairly standard information. It's hard information in the sense that once it's presented to you, you can look at it. But as Philip says, you want consistency within a company, and you don't want them tinkering and altering how they do it over time, because that can mean that trends aren't the real underlying trends. In terms of Carillion, the profits were fine, weren't they? So you look at that red line there, and you can see, oh, it's going up. It is a cyclical company, construction, so perhaps that's not great, but revenue's going up, that's a good sign. And if you look at the bottom green line, earnings before interest and tax they look static. So firstly, well, actually, I'd like increased turnover dropping into the bottom line. But if we go to those earnings before interest and tax, they look fairly static. I wouldn't necessarily invest in them because it's not growing, but I wouldn't have necessarily, on the face of it, predict this, which is that. How do they suddenly head south so dramatically? And in relevance to this webinar is, was that foreseeable? So, first of all, look at the profit and loss account. Well, you can read what a profit and loss account shows, but for me, relevance to Carillion, one of the key things was accrued. So just to give a very small example, if I have my own business, if I invoice someone, that will appear on the profit and loss account, but that doesn't necessarily mean the money's gone into my account. I haven't, in terms of the American film Show Me the Money, I haven't yet seen the money. And going back to Philip's statement about cash flow being king, profit is sanity, cash flow, well, I want to see the cash. And that is relevant, as we'll see going forwards. So in terms of Carillion's, this is the source is from Morningstar. It's all publicly available information, but it's a screenshot taken from the Carillion, from Morningstar's website. And what I've done is I've overlaid stuff on it. So first of all, we look at turnover. And turnover, well, it looks reasonably good. It's a growth company. Well, perhaps not. It's a cyclical company in a cyclical sector. So take that with a bit of salt. If we look at the earnings, the operating profits, well, you can say, well, they're sort of a bit up and down, and that's fine. But actually, what would potentially I don't like in companies is where there's consistent adjustments, because that is indicative that they're doing something. There's one-offs, occasionals, etc. That's fine. But if every year they're doing adjustments to the reported, then actually they're not, to go down here, exceptional items. And if in those first 4 columns you do a comparison, you can see that the difference between operating profit, the reported and adjusted, is matched by the exceptional items. But then if you look there on what's appearing in 2006, one of the issues is that actually it doesn't match up in that year. So what's going on there? Now, I could look in the notes to the accounts, etc., and so on, but just the fact that there's something, a discrepancy there, that raises a question mark in my mind. It's worthy of further investigation. If we also look at the net interest, well, actually, they're paying £35 million interest on turnover of £200 million. Now, that indicates to me that they have quite a lot of debt. On the balance sheet, we'll see what that debt is, but just from the profit and loss account, I can go, oh, high interest, yeah? Oh, I don't like heavily indebted companies. Put that in there. And then you can see their pre-tax profit is not going up with the turnover. It's staying where it is. So again, that's another indicator of adjustments. And then we go up to here. So the dotted amber line. So the difference between EBITDA and EBIT is the D&A, which is depreciation and amortization. And that's essentially, so if I buy a computer for my business and it's £900,000, not nine, crikey, what sort of computer would that be? If it's £900, my accountant will write it off as an asset over 3 years, so it'd be depreciated at £300 a year. That's normal for computers. But when we look at this and you look at the differences between it, I'm going, well, actually, depreciation is quite small. It's £45 million, I think, there for such a large company. I would expect a bit more depreciation. Now, that might be it's a very asset-light company, but we will see when we look at the balance sheet. So if we go on to here, this just reflects that in terms of earnings per share, the normalized and the reported, or the adjusted, and so on. And if you were to times those by the number of shares in existence, you'd end up with a similar figure. So the summary so far is, as an investor, and I appreciate you're not an investor, I'd be losing interest already, because it's not, it's got high, there's indications of high debt, it's growing revenue, but that's in a cyclical industry. It's not growing profit at the same rate. And there's some amber flags, might be putting it strongly, but there's areas to investigate and look closer at. As an organisation choosing who to do business with, and that be whether as a key provider, a subcontractor, or a client, some amber flags raised already, but we'll want to find out more. So if we go on to the balance sheet is a statement of, if you like, the assets and the liabilities. So assets are normally divided into longer term ones, more than a year, and the current falling within a year. So I can cash in current assets. So the most obvious one is cash in there. And claims and liabilities, likewise, it's, well, what fall within the next year and what are longer term. And assets minus liabilities equals the capital, or the shareholders' fund, or equity interest. And a key question in that is, has the capital increased or decreased last year? Does not usually, perhaps that's an overstatement. Intangible assets are often not, or all of them are not on the balance sheet. And actually one of the tricks is spotting those intangible assets which aren't on the balance sheet, because they can be of significant value. So for instance, a brand, I think it was Warren Buffett, often thought of as the world's greatest investor, who said something like, I could spend 100 billion on a brand and try and get branding for an alternative fizzy drink, but I still wouldn't have the brand of Coca-Cola. It's the piece of people's minds which they own, where you go, oh, what fizzy pop shall I have? I'll have Coca-Cola, and they'll pay extra for it, or go across the street to the store which has it. So if we look at the Carillion, first thing to say is look at the intangibles. It has a huge amount of intangibles on its balance sheet. And what's more, from the previous sheet, it's only writing it down at £45 million per year. As I said, intangibles are goodwill, intellectual property. Some small startup companies or growth companies often capitalize their research and development brands. But Carillion, as a facilities management stroke construction company, does not have any obvious intellectual property brands, etc. So it's likely to be goodwill from purchases. So what's goodwill? Well, if I purchase a company and its tangible assets, its property, etc., is £1 million, but I purchase it for £3 million, the goodwill would be £2 million. And in actual fact, if you dig a bit deeper into it, it's purchased an awful lot of companies which in actual fact haven't actually translated into the bottom line. So I think in 2009, Carillion purchased a green company which was loss-making. And if you delve down into those individual accounts which are available from Companies House, you'd find that every year that company has been losing money ever since. Yet, looking at that, they do not appear to be writing it off, which a prudent company might well do. So that's a big cause for my concern. If we look at the next one, and the debtors, well, actually turnover went up 450 million and debtors went up 400 million pounds in that year. Now that could be working capital, but the increase does not seem to be proportional. And I raised the question of what are the debtor days? And the debtor days is the average amount of time it takes from an invoice being received from a company and actually paying it. So you can, some ratios actually show this. I think Morningstar, actually, you can get that data from as well on their ratios page. In terms of cash and securities, though, it's, well, good. Cash increased slightly. That's good, isn't it? Yes, that's why it's a green. But how did it increase? Yeah. Was it holding on for money longer? So as with all of these things, you have to look at the bigger picture rather than just consider them in isolation. But it seems to me that actually the concern is their cash only increased by, what, £40 million, yet their debtors increased by £400 million. So that's, hang on, that's a big red mark when you think about it. And if you look here, you've got these, the current liabilities and the non-current liabilities. They're both going up significantly. So amount it owes debt has gone up by £850 million on a £4.5 billion turnover. Amount it owes owed only went up £400 million. So again, a divergence there, cause for concern. And that's reflected in the net value of the company. So the net value is that, and as you can see, it's gone down. But a large part of that net value is old and what I would consider worthless, because they don't appear to have generated revenue and profit, is goodwill from buying companies. And here's another one, a net and tangible asset. If you actually look at the net tangible asset value per share, so you take out all that goodwill, you actually, the company is actually worth minus 225 pence per share. Okay. So are you getting a sense, a picture? And what's more, look at the trend. It's gone down quite significantly, which is reflective of all we talked about. Some other balance sheet ratios. You've got the net tangible asset value there. Their gross gearing has gone up, as has their net gearing. Their interest cover has stayed, was gone up, which is in some ways you could say is good. So interest cover is the amount of profit, earnings generated, and how many times that covers how much they pay out in interest. But again, going back to it, cash is king. Is it cash which is covering that, or is it just what they've invoiced, if you like? Quick ratio and current ratio, they're virtually the same. They relate to the amount of cash they have in terms, or current assets they have in terms of being able to cover their current liabilities. And the cash has gone up, which is a positive sign. But again, take that in isolation. We're now going to move on to Stockopedia, which is a much more visual website. It costs, if you have to review stuff, it costs, I think, £25 a month, or you can get an annual subscription. As with the Morningstar website, this is publicly limited companies. And to some extent, they provide a summary. If you want the detail, get the actual accounts from the Companies House website. So why this one? Well, why this one is because it shows on the same slide, or the same thing, earnings reported and normalized, which we've covered, but then look at the free cash flow. So free cash flow is often referred to as owner's earnings. And the reason why it's referred to as owner's earnings, because it's the amount available after paying out for all the operational expenses, paying for capital expenditure, which is available to the shareholders, either to pay off debt, to pay out dividends, or to buy back shares. What you see here, and why it's in red, is if you look at either of those figures for earnings per share, and the actual amount of cash generated, the cash which actually ends up in the accounts, you can see that it's significantly less than those figures. So effectively what they're invoicing and they think they should be owed, they're not actually getting the money in, consistently so. In fact, their free cash flow is so appalling that if, so the figure would be what's their cash conversion, and it's around about, looking at that, around about a quarter to a third, and sometimes less, and sometimes significantly less. It's negative. If related to that is you look at the dividend per share. So they're paying out this dividend, and it's not even covered by the amount of cash that's coming into their bank account. So they're using debt effectively to finance money out to the dividend to the shareholders. Well, that's not sustainable, is it? So we've got that there. If we then go on to an overview of Stockopedia's first summary page, I'm just going to highlight that bit there and then drill into that a little bit. So if we go into here, this appears. Now, is often pensions aren't obviously highlighted, and in Carillion's their pension deficit, with good reasons, because they actually have an absolutely massive pension, or had, I should say, a massive pension deficit, which at some point, if they were going to continue as a going concern, needed to be paid in. They should have been making regular contributions. And one of the things which has come out in the wash is that basically they were ignoring that. They would rather pay dividends because that supports the share price. So everything I said before indicates that Carillion is a bad company, if you like, yeah? That just turbocharges it. So look at their gross gearing doubles when you take into account their pension deficit. Their net gearing goes up 4.5 times, etc. And at some point, that has to be paid back. So another look at that. If we look at these health trends here, and we zoom in on these. So if we zoom in on these, you've got Petrovsky score, Altman Z score, and just an earning manipulations risk, which is on or off. And what we're going to, and you can have a quick look, read through them, but the one I particularly like you to read is the bankruptcy risk meter. So the wordings from their website is it's a visual representation of how likely a company is to head into serious financial difficulty within 2 years. The academic thing on which they base it is the Altman Z score, where it takes certain things from the balance sheet, and then they back tested it and said actually it's got an 80 to 90% accuracy. So if we just take that in isolation, you go, not looking good, yeah. But if we go on to the next slide, where I've taken the trends, you can actually see the trend is negative. So this is Stockopedia. They have historical counts and points in time, and I went back and grabbed these and then amalgamated. That should be a minus 3.45, not a bracket 3. So before I go on to it, is it just are these just benefit of hindsight arguments? Aren't I a smarty pants coming up with this after the event? Well, actually, if we look at this is companies, the short selling. So short selling is essentially where, and I don't exactly understand the mechanism, but where people look at company accounts and other information and go, this company's share price is going down. The market just hasn't realized it. And somehow, through a mechanism I don't quite understand, they effectively make money through a share price going down, which for me always means that someone has to lose, but I don't quite get it. What you can see from this is actually 27% of Carillion's equity was with short sellers. So 20% of their share owners thought this is actually going down, this share price. And therefore, they made money out of it going down. We talked briefly about ratios. I mentioned some. I think just to emphasize that, ratios offer a snapshot on something, on a couple of aspects. They compare an aspect of it. They should not be taken in isolation. So they're not conclusive proof of anything. You need to look at the broader picture. In your world as project managers, project procurement professionals, etc., look at these accounts, actually see if there's something up. If you can't get to the bottom of it, take professional, more qualified advice. And the bigger your project, the package involved in that relative to project, the more advice is warranted. The corporate report provides a true and fair view. That's what the accountants sign off. If they don't sign off on that, you'd be even more cautious. It's not perfect. And again, something's coming out in the wash relative to the accountants, the auditors doing that. Beware accounting policies, valuation methods, etc. They're all based on professional opinion. So ask further questions, dig deeper, look for trends, etc. And with that, I'm going to hand back to Philip, and I hope I haven't used up too much time. There we go.
Thanks, John. As we can see, there was plenty of information available to spot the financial position of a company like Carillion. So now we're going to look around due diligence. Obviously, all of this takes time and resource to do, so we need to prioritise which companies we're going to spend more time looking at. There are obviously differences between private and public sector in terms of what you can and can't do. But then once we've done the due diligence and decided the approach, what are we actually going to do with the information when we get it? So using Carillion as an example, there was plenty of information out there, but what was done about it? Did anyone take any action? The Contract and Procurement Guide has got quite a lot of information in Chapter 3 around how to prioritise high and low risk packages. So that's well worth a read when you come to decide what type of approach do you want to use for different packages or trades, and which ones do you want to spend more time looking at. So do we actually assess the package risk before we look at our procurements, or do we just simply apply the same process to everything we buy? So, for example, do we just issue tenders out to 5 companies, or do we just follow the open procedure if it's a public procurement? And do we then set our criteria the same no matter what it is we're buying? So we could be buying paper cups for the office, or we could be buying £1 billion worth of project. We use the same methods. It's important, obviously, to know your industry and sector. So, for example, when we look at some of these accounting ratios, if we use that as a measure, that is going to be very different. For example, if you're in a cash-rich business, so for example, contracting, versus if you're in looking at a large manufacturing company where you would expect them to have far more fixed assets, say if they own a big factory and a lot of stock. If the company you're looking at is mission critical to your project, then it's worth looking in a bit more detail at those companies. When you're setting ratios, if you set yourself standards within the organisation, it's a good idea to think about making sure the thresholds are appropriate to that trade or sector that you're looking at, and don't necessarily assume you use the same ratios and thresholds for ratios for different types of companies. There are no one-size-fits-all approaches. Now, Ernst & Young, the accounting firm, identified a number of general risk factors for companies which are more prone to insolvency. There's a number of those on the screen there, some of them quite pertinent at the moment. A number of those you can quite easily imagine would be applicable to Carillion. As an aid memoir, we will be making these slides available, so please don't think you need to be taking notes as we go along. Basic principle in English law, caveat emptor or buyer beware. It's up to you. You as the buying organisation, the selling organisation if it's a client, it's up to you to do your due diligence. Nobody else is going to do it for you. So what are the approaches we can take? So in the private sector, there's generally a lot of flexibility to do as much or as little due diligence as you want to protect your organisation. So there are a number of ways there. We've already touched on financial accounts, credit agency reports, etc. There are also various other industry-specific pre-qualification tools, accreditation bodies and schemes available. An example in the construction industry might be PAS 91, and there are various financial questions that are asked under that accreditation body. I won't go through all of these details now, but the links there you can follow if you want to investigate these yourselves. When you're relying on an accreditation body, however, do make sure to check the method they use. How much detail have they gone into on finance? quite often industry bodies will be very focused on other things, and financial accreditation is just an aside as part of their more general accreditation. As John noted earlier with Carillion, it can be quite difficult sometimes, and sometimes you have to do a lot of interpretation around the accounts, and especially if they're perhaps a couple of years old, when perhaps they were accredited 2 years ago to a body, is that still up to date? So if it's important, double check how relevant that is to you. In the public sector, there are options for financial due diligence as well, but as a general rule, it's a lot less flexible than the private sector. Looking a bit closer at some of the selection criteria you can include, statements like possessing the necessary economic and financial capacity, look at setting criteria for minimum yearly turnover, not being more than twice the contract value. And you can also set in your procurement criteria specific ratios, i.e. between assets and liabilities. The main issue around the public sector procurement is you do need to set all these things up in advance as part of your procurement documentation. So you need to set clearly the criteria and thresholds you will measure by. Obviously, it's worth taking your own legal advice when you're setting up your procurements. As we saw with John's analysis of Carillion, sometimes it's not all that clear cut. You need to do a bit more thinking around some of it. It's not as simple as looking at just one ratio. So there are potentially issues there which make it slightly more difficult in the public sector to be able to go into the same level of diligence. So when do we do our financial due diligence? Do we do it before we go out to tender, as part of a tender, or do we do it after we've done a tender and hope the company we want to award to is solvent? And then do we monitor things as we go along? And as I said, there may be in the public sector, there are further restrictions and rules which say what you can do when. When you get the responses back, does anyone actually read them? So sometimes I've seen accreditation procedures which just says submit your financial accounts. Great, you can get that yourself on Companies House. Does anyone actually look at it when it comes in? And if you do identify issues, does anyone then act on it? Is there a governance process to review what happens around that? So if you identify an issue, what's the risk appetite? So you might, well, as we said earlier, find a company it's technically insolvent. That doesn't mean don't use them, but what is your company's risk appetite to go forward? What are the commercial and management measures you're going to put in place to manage that relationship going forward? Obviously, it's much better to avoid the bad deal in the long run, so it is worthwhile doing the due diligence up front if you need to. So what more can we do? So clearly, John presented a number of items of information on Carillion, so there was plenty of information out there. So query would be, do we apply the same level of due diligence to all our trades and all our contractors? Do we apply the same due diligence? And what do we do with the due diligence when we get it back? How do we act upon it? And are we actually able to act upon the due diligence? So are we restricted by other rules? And are our internal governance, or are there any external governance procedures that restrict the amount of due diligence and how we can act on it? And then once we appoint the contract, what do we do once it's appointed to keep an eye on things? It's not a one-time activity. Things can change overnight. The economy can change. Brexit might impact your supplier. What's going to happen in 6 months' time? So in summary, insolvency can clearly be very debilitating for your project or even the whole sector. Lots of information out there, but do we do our due diligence? Do we go out looking for this information? And importantly, do we act on it when we get it? As John touched on earlier, this is the first of a series of seminars, and the next seminars will look at what measures can we take in the contract, and then if we do ultimately get to a position of potential insolvency once we're in the project, what do we do about it? We've come to the end of our slides. There's obviously a huge amount to take in there. I think we do have a couple of minutes for questions.
Okay. First question for you, Philip, is which were the reputable providers, agencies of credit reports, please? could you provide some agency names in writings over here?
Yes, we can look at providing examples of some of the credit agency companies. So some of the more better known organisations like Dun & Bradstreet, Bureau Veritas, etc. It is also worth checking with your business banks as well. They often provide credit agency support. However, just Google Bureau Veritas or Dun & Bradstreet, for example, and I would expect it would pick up quite a few of their competitors. Additionally, your commercial or your accounting teams will have a very good idea in your business as well of who you can use. But they all offer slightly different products. They've all got very powerful tools that can dissect reports. So there are a few different ones out there.
Okay. One for me, I think, is what are adjustments in operating profit? So this is from the exceptional items. Well, hopefully they are exceptional. So that might be for a relatively small company. A client goes bust or something like that. Yeah, that could be an exceptional item. For Carillion and big construction companies with hundreds of projects, a project or a contract makes a loss. Well, actually, that's run-of-the-mill business, if you like. If you're constantly reporting that as an exceptional item, when you've got hundreds of projects, I don't think it should be an exceptional item. You should make an allowance. Perhaps a really big one goes bust or something like that. That might be. How can we access visual indicators such as the ones you, and I think looking at the time of me, show for the 2016 accounts? Those ones were taken from Stockopedia, which they gave me permission to use. Another one is ShareScope. That's not quite as visual, but it is more detailed. Morningstar offer an awful lot of free information, but not quite as visually nice. And I'm sure there are a few other ones out there.
Yeah, the credit agencies, typically when they provide a report on a company, many of their reports include graphs and visual warnings as well. So they'll present a graph of trends, caution graphs and various other things looking at different pertinent information. So there are a few different options.
Okay. I think that's all we have time for. So with that, I'll thank Philip very much indeed for putting together the slides and taking the lead on this and giving the presentation. I would point out again, this is the first of a series of 3. The next one is on what you can put in your contract to, not sure about avoid the risk, but reduce the impact, shall we say. And then the third one will be on what happens when you're a live project manager and people start showing the first signs or detecting the first signs of insolvency. What do you do as they're becoming insolvent, and what do you do if they do become insolvent? And with that, I'm going to sign off. Thank you very much.